All right, we are live on the social medias. I think we're on LinkedIn, Facebook, and YouTube today. But everybody, welcome back to another episode of Military Finance 2.0, brought to you from US Vet Wealth. I'm Scott Tucker, along here with Trevor Maxwell, where we're getting all the basics that you need to know about in the financial world that are typically the kind of stuff that they make it feel like only the experts know this kind of knowledge. And today we're going to talk about market risks and what these things mean. They make it sound complicated because they think you can't understand it. And we're here to tell you that's not true. You don't have to go back to look at the episode we talk about on fees. You don't need to necessarily pay someone all this money to get pretty basic level stuff that honestly you need to know. It's your money, so that's kind of the point here. We want to empower you so you can get this basic stuff. It's been really put up on a pedestal all these years, and the reality is most of that stuff can be automated. You can do some other stuff with it and then free yourself up, free your time up to really go build a strategy for creating wealth. So that's the whole point around these series of episodes. And Trevor, how was your weekend, man? But we'll start getting to check
It
in a
was
little bit.
it was really good. I actually didn't do work this weekend, which that's been a big thing for me. I was like, all right, I need to just bust my ass really hard through the week and take the weekends off because I haven't been doing that. And
Yeah.
this morning I woke up, I kind of shook it off and sat down. I had my list of everything I needed to get done this week because last week I just had a couple of those days where I had so much to do, I just got paralyzed and I couldn't do anything.
Yeah, I mean that's a reality. I mean, talk about risk. That's the risk of being a self-employed, and some people think, oh, I can't do it. I need to go into office. I need to have that, and so there is the trade-off. It's just realizing that there's the difference between self-employment and employment is you can make that choice. It's like I ain't feeling it today. It's like, okay, then don't do it. You take that time off. I only got a couple hours into me. You're never just showing up. I mean, because honestly, like when I was in a office job in the military, most of it was just showing up and staying until the time said that you could go. You had to show up on time for whatever reason. That's important. And then you can't leave until they say you can leave. And some reason that's important. And whatever happens in between doesn't seem to matter. Whether or not there's even is work, let alone if the work got done. And that's what really that was my first look inside bureaucracy, and that's how big corporations work. It's all the same. A lot of people are sitting around. There's a reason we talk about talking around the water cooler because people are just trying to eat up the 8 hours that they're required to be in a different location, or be doing a specific task. And so that's the trade off with self employment. You get to choose when, if you want to do something. Same time, sometimes you got to motivate yourself, give yourself grace, permission to take some time off, but that can be a risk. I know there's a couple years there where I was really lost and I was trying to find myself and really just find friends and stuff. And I woke up 2 years later. I was like, I don't think I was working on my business. It turns out later I was. It was more in the developing the thoughts and the philosophies and the ideas that went into the book. But at the time, I really felt like I was just bumming it for a few years. Turns out I needed to give myself that space to be able to do this kind of thing now. So, no, thank you for sharing that. I think it's
Yeah,
it's relevant to the overall conversation of finance. I mean,
it
right?
is.
Yeah.
Well, you were talking about that. I remember that when I was on a ship, right? I was on the USS Enterprise. It's an aircraft carrier. It was like that. It was exactly like that, where we would be done with everything and we would just have to sit there. It'd be, 2 o'clock in the afternoon and we're done, but we can't leave the ship till 3:30.
Mm-hmm.
And so, your boss would come in and be like, "Well, go clean something." I know there's always something to be. That's the thing, as they say, there's always something to be done. I'm like, yeah, there is, but is there really? So, when I left the fleet and went to EOD and I became a team chief, I remember we had this new guy that came to our team before we went to Afghanistan from another team, and that team chief had that very fleet mentality where he was just like, "Nope, we're going to sit here till working hours are over, and you guys do something, whether you clean the shop or read publications or whatever." And I just hated that. I was like, I came to this community to get away from that, right? We're
Right.
critical thinkers, we're smaller units, and so this new guy comes to my team, and he's getting all this stuff done, and I am in there in the office and I see him sitting on a couch in the team room, and I'm like, all right, well, he's leaving. I was like, hey guys, I'm going to lunch. I come back from lunch and he's still sitting there in the exact same spot in the couch. And I'm like, bro, what are you doing here? He's like, well, I'm done. I was just, waiting for the day to be over. And so I look over at my LPO, who's like the second most senior enlisted guy. And I'm like, Eric, what the hell is he doing here still? And so he just turns around and goes, Troy, go home. And I thought, I was like, bro, this, I'm trusting you to be a big person, right? We always say that, like, people in the military don't understand what big boy rules are, or that's what we used to call it.
Yeah. I mean, we're afraid half getting through the service in the military is just trying not to get in trouble, right? And for whatever reason, somebody says, well, you left before the thing, and they just make a huge deal out of it for no reason. But I think if I were to do it over again, if I was ever in command, I just say, all right, every day, if you're done early and we're not allowed to leave yet, we'll set up a little office where people can come and learn some other skill set.
Yeah.
I mean, why not prepare for the transition during that dead time during your career? But anyway, so what are we chatting about today?
So today we're going to talk about the effects of market risk. And, this ties into a discussion we had a couple of live sessions ago where we talked about systematic and unsystematic risk. Those are the two main categories of risk whenever you're talking about investments. And so really market risk falls under the systematic. If you remember, systematic is kind of like total market. You can't really do anything. You can't avoid it. You can try to mitigate it. Well, that's what they say, right? Well, that's not 100% true. I was waiting until today to really talk about, like, how do we hedge that risk, right? How do we manage that, right? Because that's a big thing. Like, you can never completely avoid risk at all, ever. There's always some kind of risk, even if that risk is just opportunity cost. Like, I did this, I lost the opportunity to do that. So that is a risk in and of itself. But yeah, so you have the systematic risk, which market risk falls under. It's kind of like the big macro kind of thing. And then you have your unsystematic, which is, that's a risk associated with a particular investment or a particular company. So market risk is big picture. Look at, last year, April of last year, when the market dropped as much as like 30%. Like, I remember talking to people and they said, oh my God, my TSP, like, literally the last 2 or 3 years of my TSP has just been wiped out. And I'm like, oh man, that's crazy, isn't it? 2 or 3 years of work has been wiped out by
I did all the right things, and overnight, this new thing showed up, whatever it might be. Elon Musk tweets something, whatever it might be. It's like, I did the right thing. I did the savings. I did the thing the financial planners told me to do. And yet I'm negative. Like, there's cognitive dissonance in that. Yeah. And then people say, okay, I'll just keep doing it.
And here's the thing. Here's my favorite line. Well, it'll come back. Like, right. It will come back, but how good of a position will you have been in? Think about it like this. Like, this is the oldest one that I've ever heard. If you're trying to push a big rock up a hill, and every, however long the hill is, right? Every, 100 or 200 yards, you make some progress. And then every once in a while you slip and the rock rolls down 50 yards and you have to get back and push it. Like, imagine if you didn't have to worry about slipping and, you just stopped for a while, regained your footing, took a break, stretched, had some water.
And by the way, you have no idea how long or how far you need to push that rock.
Yeah.
Or if you're going to get to the other side and think you hit the top and then realize there's a whole nother mountain range to go over. Right.
Yeah.
And that's kind of how people are told to do their retirement planning.
But yeah, it's true. It does come back. But, well, okay, how much does it take to come back? Oh my God, have you ever seen any of those graphics of like what it takes to recover from a loss? I think they say, let me see here. Maybe I have something on my computer. I think I made this a while back. like what it takes to recover from a loss. Okay, I can't find it on here. But I made one. It's I think it takes, what do they say? Like in order to recover from a 30% loss, recovers a 43% return.
Yeah, it's like, well, if you have a 50% loss, you need a 100% gain.
Yeah.
So think about it that way. And bottom line is, easy way to look at it is this way. It's like you got $1,000 in year one, you get 10% growth. So what do you have next? You have $1,100. Year two, you get 10% loss. So does that mean you're back at 1,000? No, you're at $990. So it's
Yeah.
like, what? That's the difference between average return and real return. It's so important to understand how that's systematic I mean, it's just rules of math, and we
Yeah.
overlook it.
Well, on that same note too, right? If you people look at that average rate of return, and I hate when they do that because looking at the average return doesn't necessarily mean anything, right? I've seen this. This was in one of my textbooks. I don't know, that for a class that I took last year, where I say like, hey, you know what? If I have $1,000 and it does 100% that year, that first year, right now I have $2,000. Well, that next year, if I lose 50%, now I'm back at $1,000.
Mm-hmm.
So if you look at, okay, what was my average rate of return over that time? So I have a plus 100 one year and a minus 50 the next year. Well, okay, 50% over those 2 years. That's how the math works out. You divide that by 2. That means I had an average rate of return of 25%, but I made nothing, right?
Right.
And chances are I probably lost something because there's fees involved too. But
Right.
I mean,
Fees, taxes.
yeah. So it's weird how I always look at like, okay, what's the dollar amount I made? Actually, I did have this. Let me share this one that I have, because I was talking to somebody about this the other day. I showed them what you really want to pay attention to is what is your compound average, right? So there we go. Let me share this. Okay, here I did this a while back. This is one of my. I don't know what to do, so I'm just going to nerd out and do some math here. All right, so this is.
We're all there at some point in our lives.
Yeah, right. Well, I'm probably a little worse but anyways, okay, if I had $1 million, I'm retiring. These are the actual S&P 500 returns from 1999 to 2019. So, start with $1 million, end up with 2.6 million. Most people would say, oh, okay, but this is just to demonstrate a point about math. Think about this. If this is your retirement funds, you're actually going to start taking income out of this. It's going to get a lot worse, right? So my average rate of return, I'm just here to demonstrate a point here. My average rate of return for this time period is 6.25%. However, my compound average, that is in order to start with $1 million, let it sit in there for 21 years, and then end with $2.62 million. What was my real rate of return, right? 4.94%.
Can you move that hide? Can you hit hide there just to move that thing?
Okay. There we go.
Yeah.
All right. So yeah, it was my compound average was 4.94%. So that means my rate of return, what I actually got, was really less than 5%. And that's funny. Like when I hear people say that, like, oh no, 7 or 8%. And I'm like, no, not really. A lot of people say, well, there's funds out there that do a lot better than the S&P 500. And I'm like, well, yeah, they do, but they probably also have a little bit higher fees that you're paying as well, because that stuff isn't free. We talked about that last time, right? Don't get mad because something costs you something.
Yeah. Well, I mean, that's something to look at specifically with TSP, because they show those numbers, the returns all the time, how the G fund did, because everybody's in the exact same fund, right? So what with C fund, I fund, or the life cycle funds, whatever it is, they're showing the returns that are misleading, and everybody's in the same boat, and it really compounds into the group think and how you're supposed to do saving for investment and retirement, or not even thinking about we're thinking, I put money in TSP, therefore I have retirement. It's just like there's so much more to it. How are we even allowing that to get out into the ether, that it's just basic, just sign up for TSP and you're good to go? That's what the majority of our military, from people I've talked to, it just kind of feels like a benefit. It's in there. It's like, oh no, there's so much more to it. And it's not just because there's no cost or almost no cost involved.
I kind of think of that as like the difference between, oh, look, there's a car,
Mm-hmm.
or hey, there's a car that will actually get you from A to B for as long as you need it to do it. And
Yeah.
you
And,
don't,
and, and those are, I mean, those are risks. I mean, all these things are risks inherent in, basically it's decision risk, misinformation or uninformed, risk of being uninformed. But specifically for market risk, what are we talking about?
So, I mean, really, market risk is the chance that ups and downs in the market are going to cost you money, and really, this, to be honest with you, sometimes that actually works to your advantage when you're building assets, right? If
Yeah.
you're talking about dollar cost averaging, hey, I love it when I throw. Guess what? Like the Betterment thing, when you and I linked up was right around when all this stuff was happening last year. I got on Betterment and I threw a big chunk of money in there. And guess what, man? Because I got in at the bottom of that, my return since then has been like 35%.
Mm-hmm.
So that's awesome, right? I wish I would have thrown more in there at the time that I did, but
You also acknowledge you have absolutely no
yeah.
idea what was going to happen.
No, I didn't. Nobody knew. I was like, well, because that's the same question everybody has, right? They get into that analysis paralysis,
Mm-hmm.
kind of like we talked about at the beginning of this, right? Where I was like, I have so much stuff to do. I don't know. If you have too many factors, variables in your decision, you're just going to lock it up. But you're going to make an indecision. We used to talk about that in our training all the time. Like if you're like EODs or EOD techs, when I was, working with Army Special Forces or the SEAL teams, they watch for that. Like when you're in those dynamic environment, when you're in a kill house and you freeze up because there's like so much stuff to do and you don't know what to do, that's one of the things that they train you to get past.
Mm-hmm.
And if you can't get past it, then they start saying, well, maybe you shouldn't be doing this. Same kind of thing too, right? I didn't know that the market had bottomed out then. And in fact, I actually didn't make I actually caught it when it was coming back up. I didn't get the very bottom.
Mm-hmm.
And then a couple months later, I did the Roth IRA and moved some stuff over there. And I looked at the difference, 2 months of recovery versus back in April when it was really bad. It's about a 10 or 15% difference. So dollar cost averaging, great when you're putting money in. It's awesome. If you can catch but here's the mistake that everybody makes. Oh, I know I can time it, right? I can look at everything and I can time. Well, here's the deal. Like when you're investing, a lot of people think that when you put your money in to like your E-Trade account or whatever, that you're going to get that price right away. That doesn't always happen, right? If you understand how those markets work and how, buying and selling securities, you don't necessarily always get that price. You don't, maybe your order doesn't even get filled that day. Maybe they put it in the next day.
Mm-hmm.
But people just have this thing like, oh, I'm going to capture the absolute best price all the time. Like if you really knew how that stuff worked, you wouldn't think that.
Right. So what you did last year, you saw an opportunity for a trade versus I'm going to, that was conscious. I don't know how this is going to go versus I'm just throwing money in for my retirement. And really that's kind of what I like so much about the war chest strategy. When I realized what was happening is that inherently, because of the way the investment vehicle, the cash value insurance vehicle works, you get a reset. So every year the market resets within the policy. So that way you're kind of getting dollar cost averaging. So no matter what happens in the market, your account's always being reset back to that year's gains. And so, I mean, we have to go into a lot more detail to explain how it works, but it's like you can actually participate in a version of dollar cost averaging that doesn't have anything to do with the timing of the market. So it's quite fascinating when we understand how it works and tie it into a version of dollar cost averaging. So that's why the war chest strategy is powerful, and that it takes advantage of that, but at the same time without any risk of losses on the downside. So we'll have to go into more
And that's
detail about the dollar cost averaging aspect of the war chest strategy and why it's better than the traditional one. I mean, the traditional version of dollar cost averaging is just a way to explain away market risk as a good thing. And it is. But the bottom line is, Dalbar study shows every single year, as much as we tell people buy low, sell high, or dollar cost average in, you can dollar cost average all day long. You might have done it for 20 years. But now you're in your 50s and your retirement account's at, $500,000, and the market takes a 20% hit. Now you're down to 400,000. It's like all that dollar cost averaging stuff sounded nice and it got you to where you were, but now you're going to make the big mistake and sell at that point and miss the rebounds and all that kind of stuff. With the war chest strategy, that's just off the table. It's just not, because you don't have to worry about losses, and it takes a lot of that market risk off the table, systematic or unsystematic.
Yeah, that's a good thing, and we'll talk about that when we get to the end of this, right?
Mm-hmm.
Like, how do we manage that risk? So the other side of dollar cost averaging, okay, what about when I'm taking money out, right? When I'm withdrawing that, when I need the income to pay my bills, when I use all that money. So let me share my screen again, because guess what? I have another thing to show you here. All right, I don't know how to. There we go.
You can just hit hide. Don't hit stop sharing.
Well, when I did hide, it
no, it just hides that. Off. No, you hit stop sharing by accident.
Okay. No, it goes back to this.
Huh?
Okay. There we go. Can you see it right?
Yeah.
Sorry. I'm new. I'm new to StreamYard. But anyways, okay, so that's the returns there. Okay. Well, now we got to take income out, right? Mm-hmm. What do those returns do over the next 21 years? Speaking of which, too, your average retirement, I think they say, is about 25 to 27 years. And within that time period, you could typically expect anywhere from 5 to 8 years of down years. But one of the big things here, look at this time period, right? You have right at the beginning, not only do you have 3 down years in a row, you've got 3 bad down years in a row. Mm-hmm. You lose 10%, 13%, 23%. I couldn't imagine if these numbers were reversed and you lost 23% up front. Mm-hmm. But anyways, I mean, like, dude, if you're in retirement, think about this. You're 10 years into your retirement. You've only got $400,000 left in here.
Yeah.
Right? Oh my God. I couldn't imagine that. And then you take, I couldn't imagine how bad of a position somebody would have been in 2008 that was in this scenario.
Right. And this is called sequence of returns risk. And it's the aspect of, okay, we're always talking about, the investment risk as we're accumulating assets, but what you're talking about is actually using the assets. And as you draw down on your accounts, if that happens to be, it's like, all right, I'm 60 years old. I want to retire. I'm going to start using my money. But I'm probably going to live another 30 years. I got to beat inflation. So I got to keep it invested. And that year you start to use your money. Also just happens to be the year that, COVID happens, .com bursts, real estate market bursts, whatever bubble is coming next. We all know it's there. Crypto, one market affects the other, and it's always going to affect the stock market. So if in that year you decide to actually use your money, is when some sort of negative crash happens, it just eats away at the equity that much faster, and it can have you run out of money. I've actually there's a website with a calculator, so let's do another episode specifically on showing some examples of sequence returns risk. Yeah,
absolutely.
Because really that's a version of it's a version of market risk. But I'm glad you brought it up, just to show like these things happen, and you don't know if you're going to need the money in the year it happens.
Couple other things in here with this, right? This is without a buffer. And people are saying, what's a buffer? Well, I'll show you what a buffer is here in a minute, right? So one of the other big things you see here, we start with, $40,000 of income. Well, here's one of the other great myths that I hate hearing when you talk about investments, right? Everybody says the 4% rule. what is the 4% rule?
Yeah,
They
right.
say the 4% rule means you can withdraw up to 4% of your assets under management to pay your bills, and not there's like a what is it? There's a greater than a 90% chance that you'll never run out of money. The
Right.
problem that I have with that is that what I did, the math I used, I increased this right here, your withdrawals every year by 2.5%. What's
Hmm.
2.5%? Well, that's about what inflation is,
Right.
right? I need to do that in order to be able to have the same buying power that I had in that previous year. So the 4% rule would not apply here. You wouldn't have enough money to pay for all of your stuff. So if you're retired and you need to be able to pay your bills and take care of everything, you can't afford not to take this amount out every year in order to be able to take care of that stuff,
Hmm.
right? So if you have to take money out when the market's down, well, okay, I'm kind of screwed now, because here I am in year 21 and I can't take out the full amount of what I need for the next year. I'm going to be broke. Um, well, what do? We have a buffer. I'll talk about, well, what is a buffer?
I just want to say something real quick. I mean, what blows my mind, and following the rules of thumb of financial planning, that's the main one, the 4% rule. Never take out a 4%, and you won't run out of your assets in retirement. And the way I look at it is, man, I managed to save $1 million, like in this scenario. Imagine hitting $1 million. I remember my dad, he was in his 60s. He had saved $1 million. And then what? It's like the only reason he used any of it is because he had to, required minimum distribution. And I'm looking at this. It's like I created $1 million asset, and I can only use 40,000 of it. That's it. Does that feel like,
Because I'm
wealthy
worried
in
that it's
financial independence? I mean, but obviously there are other ways to invest $1 million that could pay you back. So these are withdrawals. They aren't income. It isn't producing income. So, that's a huge factor, because another reason with the war chest strategy, because we're not worried about losses and we've got that the loan provision, we can typically take closer to 8, 9, even 10% annually, as opposed to that 4%. So we're getting a
yes.
little bit more access to what's available for a number of reasons we won't go into today. But
Okay,
yeah,
but one thing I will say, okay,
yeah,
well, what if we did have a buffer? What kind of position does that put us in? When I say buffer, I mean years where I have a negative return, I'm not taking money
don't
out,
take it out. Yeah.
right? So I'm enabling my assets to recover because I'm not taking it out when I'm done. So, I still go through and I take, I'm just taking it from other sources that aren't necessarily tied directly to the market.
That's
Meaning,
diversification.
yeah, yeah, right. That's kind of one of the points I was going to get to towards the end. But now, okay, hey, I'm not taking money out when the market's down. And look at that. Oh, okay, I still have, you know, just under half of what I started with, and I've been able to take all this income out. So, that to me, that I just it's sad when I see people like 100% in that. That's why I don't like when I hear people do buy term and invest the rest. Well, that's because the only investment advice they get is, well, just go buy mutual funds. It'll they're
Mhm.
like, no, not. I mean, I just showed you the math. If you have to take money out, could you imagine if you had to take out like extra money or one of those down years? Like, oh, my car broke down. I'm going to pay cash for my car, so I need to take another $30,000 out so I can go buy a car. Um,
What
look
do
at
you
how.
What do you think? What do you think the agenda is behind? I mean, we always pick on Dave Ramsey, but whatever. It's like the agenda of the mass market um, approach to this level of guidance. I mean, the idea of buy term and invest the rest. What's the in it for them to tell everybody that blanket advice? Is it just the idea of kind of creating this cult mentality where everybody talks about, it's easy, and so therefore, it's an easy way to build a brand and to get more books? I mean, that's the only thing I can think, that they would just give this blanket advice to huge populations of people, assuming that this is the one way and the true way. It's like, what's in it for them? Because it's not like all those people are investing with them on their particular strategy. He's not selling a mutual fund or anything like that. He's not selling insurance. directly. I mean, he gets there's
No, but
ancillary things, but it's like, what's in it for him to give the blanket advice?
well, okay, so I and I talk a lot. I actually some of the stuff that he says, like I agree with.
Of
I
course,
think on
yeah.
the basic, like, hey, if you're $50,000 in credit card debt, you should not be taking your kids on a Disney cruise. Like, to me, that's very common sense. The stuff to me that's not common sense is like that, like the hey, buy term and invest the rest, and all you need is a big chunk of money and you'll be fine, right? Because
Mhm.
no, that's not how it works. Now you start looking at taxes and market loss, but a lot of that is based off of, I mean, it's really all one big marketing strategy. It's
Mhm.
because people who do sell insurance and mutual fund shares and stuff like that pay them lots of money to say, hey, funnel business our way, right?
Right,
So
right.
you go out, you look at, like, what are people afraid of? I mean, that's really what it comes down to. What are you afraid of? Oh, I'm afraid of car payment. Why are you afraid of a car payment? Well, I just don't like having it. And I'm like, okay, have you considered the possibility that maybe that's actually the smarter way to do things? And you take that big chunk of money which we already have done the math on that. Maybe you take that chunk of money and do something with it instead of, you know, paying cash for a depreciating asset. That's
Mhm.
the one that kills me the most. The people that pay cash for cars.
The car thing, it's I mean, my thing would be, it's like, oh, I don't like making my car payment. It's like, then don't have a car. Well, I have to have a car. It's like, no, you don't. No, you do not. Move closer. No, I live way
Do
far
you?
away. Sell your house, get out, move, change your job, change whatever it might be, work from home. Oh, I'm stuck in the middle. I mean,
It's all give and take, man.
there's no requirement when you sign up the military to own a car, or to own
No.
any of this stuff that they say you have to pay for. It's all keeping up with the Joneses, in my opinion.
It's all give and take. But okay, so we'll kind of bring this home. Okay, how do we avoid market risk? Well, a lot of people say you can't. I'm like, yeah, actually, you can. You may not be able to completely avoid it because the downside to not being in the market at all is that, okay, there's maybe a liquidity concern, or maybe there's the concern that your money won't keep up with inflation. I mean, you and I know that that's not true. That there are things that can do that, but a lot of people just feel like, oh, I have to do something in there. And
Mhm.
eventually I get to the point where it's like, all right, I can sit here and talk to you about all this stuff I know till I'm blue in the face. Eventually, you're going to go out and do this anyway. So, what's the best way I can help you mitigate that? Right? How do you avoid market risk? Okay, really, there's three main ways. There's uninterruptible income source, which for like me, I have my retirement and VA disability. Social Security, I don't tell people to count on because that is not. We don't know what's going to happen with that over the next few years. Just because the government is doing it doesn't mean it's secure and safe. Um, Diversification, and when I say that, we talked in the last one, the systematic and unsystematic risk, about how diversification in the market can eliminate or reduce the amount of unsystematic risks. It doesn't get rid of the market risk, right? Because you're still in the market. So get into investments that are outside of the market. Well, what is that? What are some things that do that? There's like permanent life insurance is one. The index universal life is a great tool for that, right? Because you still get to take advantage of the upside and you don't have the downside. And people will say, well, there's costs involved with that. Yeah, there's costs involved with everything. But I would be willing to bet you that if I sat down with somebody and did an illustration for them and show them what the costs are, it wouldn't be what they think it is, and it wouldn't be what all the gurus are saying. Well, that's going to cost you so much when you're
Mhm.
old. I'm like, no, the people who say that don't know what they're talking about. Like, I've actually sat down with other people who work in life insurance and show them, like, hey, here's how you do this the right way, and they're like, huh, well, yeah, I never knew that.
Oh no,
um
it's all surface level. I mean, I knew that from
yeah.
being with a broker dealer firm for 7 8 years, and it just stuff never comes up. It's like it's like, I was joking about earlier about, the financial advisors hoard all the knowledge. It's like, no, they hoard all the buzzwords,
Yeah.
but the actual knowledge and how these things are designed, they're mostly relying on some expert, basically some wholesaler who teaches them how to do kind of a sales design. Here's a design for a particular problem to talk to somebody about. And
Yeah.
so a few people have done what we've done, and really learn from these people how these things work, and then applied it to the unique scenarios versus it being a sales strategy or something like that, where you don't actually know what the inner workings are, what's going on, especially with things like cost. I think I was fortunate. I was selling insurance for years from a broker dealer before anybody even showed me the page where it explains how the costs work. And when I saw it, I was like, I didn't know that was there. And I've been doing this for a few years. How did this never come up?
Yeah.
And so
Well,
that was a scary thing for me, because I'm like, did I do the right? Luckily, I didn't do anything but bad, but it's just like, how does this, you got to at least know how the function of the thing works. So that was a shock for me, that it wasn't important in the industry or in my firm or the firm I was with to teach me that. Or I didn't even know better. It's a bit my fault for not looking into it deeper at the time. I was just assuming that my mentors were being honest.
Well, and that's the thing is they just, whatever. Is it really relevant to me making the sale? No.
Yeah.
Okay, I'm not going to go through it.
Well, it might,
I get,
even worse, it might dissuade the sale, because it might scare the client off. It's
yeah.
like, well, then you don't know
I
how it works if you can't explain it.
But yeah, so I mean, I do go through all that stuff with some, like I've sat on calls with somebody for like 2 or 3 hours just going through something.
Yeah.
I tell them, like, I'm going to let you read all the fine print stuff on here and you can ask me questions about it. I'm not going to go through, I'm going to show you the parts that I think are important. And then I'll send this to you and you can read through the rest of it, write down questions you have. And I'm more than happy to jump on another call and go through it with you, but I'm going to explain to you the important parts of this.
Right.
So, diversification is that's one way, getting outside of the market. Real estate. I love real estate, but guess what? There's a real estate market too. There's real estate bubbles, and, people are, real estate can fluctuate. Right now it's fluctuating. There's a lot of houses going up for sale right now because there was a severe shortage of houses a while back, which drove the price up. Well, guess what? Now all these people are like, oh, I'm going to try to sell my house and take advantage of that. You and all of your friends are bringing the prices back down.
Oh, is that already happening?
Yeah.
Oh my God.
I'm
Because a
seeing,
few weeks ago, I heard that, hey, there's 1 million houses for sale in the market. There's 1.5 million realtors, and that's not a good sign.
well, you and a whole bunch of other people have, and most, like, really realtors, I think they're kind of like financial people that work in financial services, like
Yeah.
you and me, that I don't think a lot of them make it past the 2-year mark, but the ones who
No.
do are normally, you're like, really successful.
Yeah,
So,
it's the same in our industry.
um,
Yeah.
and then, the last thing, that's where that buffer comes in, right? Which is kind of a combination of having that
It's
stuff
Monday.
that's outside of the market. Yeah. I've only had 3 cups of coffee this morning, so I'm a little slow, but it's that combination of having stuff that's outside of the market, and it's something you can rely on, to where when things don't go according to plan. I always look at it as like, whenever we go out on the big mish, you didn't have just one radio frequency, right? You had 2 frequencies for everything, right? Command Net had 2 frequencies. Recce Element had 2 frequencies. Assault had 2 frequencies. You had 2 or 3 different HLZs if somebody had to be medevaced. Same thing. It's the same concept, right? You're not always going to have perfect conditions, so you need to be prepared for all the conditions. And really, it's not that difficult. It's just having somebody who understands. One, hey, I'm going to focus not just on how do I build assets, but how do I take them out? Like, that's the big one to me. Like, you have to understand that stuff when it comes out. That's the important part, right? Because you're not working anymore. You're not generating any new income. So you have to be able to live off of, whatever you've saved up over the years. And 2, how is that treated from a standpoint of market and taxes?
Yeah.
So,
No, and that's the most important aspect of the war chest strategy. It's the strategy of actually using your assets at any time for any reason that you see fit, and that I feel is the most important point of all this. To stop following the orders and the rules of what society dictates you do with your money, and participate in the modern economy. But for things like retirement accounts that are subject to market risk, because things like 401ks and Roth IRAs and thrift savings plans, TSPs, there aren't many options. Yes, you can do self-directed, you can do some gold and probably crypto and real estate in your IRAs. That's harder for most people, and they're not going to manage it. But and so you're going to be stuck in the market typically until now. Of course, it was available before, but it was one of those more expensive options. If people really wanted guarantees, they could pay for the guarantees. That's not the case anymore. And that's what I write about in my new book, Veteran Retirement Rescue. It's so for those retirement accounts that you have that are subject to market risk, and you're starting to understand these things we've been talking about, you can avoid it. You can avoid it now. You can avoid the fees. You can avoid the losses. You can still get growth. You can avoid all the complications of management around it. I talk about it all in the new book. You can get access to the PDF version of it. If it's all available on Amazon, you can get those. So when you go to the veteranretirementrescue.com, you can grab the book, watch the webinar. And also, if you'd like to chat with us, of course, about how to protect your retirement savings from the certainty of uncertain times. Thank you, Trevor, for that awesome subtitle. That's what the Veteran Retirement Rescue is all about. So really a big push for us right now, given, how things are we're always kind of like, hey, market's at all-time highs. At some point, it's going to correct. And so the fear is, it's two things. We're worried about market losses, but here's the weird thing. As you alluded to early in the episode, even after last year's crash, market came back up, all-time highs again. Everybody thinks the economy, everything's doing great. And this false, it's completely false. I mean, everybody knows they've just printed money out of thin air. That said, it doesn't matter, because if the market just keeps going up and there isn't a crash, now we have FOMO. We have fear of missing out. So now it's a catch-22. It's a double-edged sword where it's like, I'm worried, hey, this is a false economy. The market's going to crash at some point like it did in 2008. A bubble's going to burst. Where am I at risk? Is my real estate going to drop, or my retirement account's going to drop, especially when I'm closer to needing it? But what if they just keep kicking the can down the road? You don't want to just be sitting in cash or sitting in the G fund. And so that's what the Veteran Retirement Rescue is all about. We can participate in the growth of the market without the risk. So we can knock out not only the fear of loss, but the fear of missing out on the future growth. So it's just really cool. It's just an innovation or an upgrade on existing tools and strategies in the investment insurance space. We're not talking about crypto and stuff. I'm hoping at one point you can use crypto inside these things. It's just not available yet, but that's what it's all about. So really excited to share that stuff with you guys. And yeah, we'll see you on the next show on Wednesday.
Have a good one.